Ladies and gentlemen, Greg Michalowski. This is the end of the week report. Today's date is August 15, 2014. I'm going to talk geopolitical politics is back on. What do I mean? Russia, there was a report over the news wires that Ukraine destroyed a Russian military vehicle coming across the border. Now, there was other vehicles reported this week coming across. In fact, a big convoy of humanitarian vehicles. I put that in question marks, and maybe there were, so I'll give them the benefit of the doubt. But the humanitarian vehicles coming across the border to help the people in Ukraine, I guess, from Russia. Well, they mixed in some military vehicles along the way, and the Ukrainian militants or rebels destroy that vehicle, increasing the geopolitical tensions, and that should be not good for currency pairs like the euro. We're also seeing a flow out of stock markets and out of bond or into bond markets, I should say. The Dow is down 91. Currently, the Nasdaq's down 966. The German DAX index is down 1.44% or 132 points in trading today. Give you an idea, the Dow Jones is down 0.55% in trading here today. For the month, the DAX is for the last month of trading, the DAX is the worst performing stock market at down 6.45%. Part of that is the geopolitical headwinds that would cause from things like sanctions against Russia. They're a big trading partner, let's admit it. And this is more painful, or should be more painful, for the European economy, and we're seeing that reflected in German data as well. The ZU survey of economic or investor sentiment this week came out much weaker than expectations. We also saw CPI and GDP out of the Eurozone and Germany come out weaker than expectations. Not very good. Industrial production also lower this week in the EU, and all that is weighing on the stock markets in Europe, and also leading to a flight into the relative safety of bonds. German bonds are moving higher, with the yield moving below the 1%, and U.S. bond yields also down sharply this week, down to 2.32%. So that is a lot of the flows that are happening. Ironically, gold is still down on the day, so that's kind of weird, down about $10, I think. Crude oil is up $1.26 in trading here today, but still below the 100 level, and Brent crude is trading at 103 up as well in trading here today. Now, what's happening in the foreign exchange market as we end the week? And so I'm going to switch my gears from the fundamentals and take a look at the technicals of the major currency pairs. I'll start off with the euro versus US dollar, and what we see here over the last 15 trading days, to be exact, where my cursor is moving around here, is a range of about 113 pips for the euro versus US dollar. We also have this 50% retracement level here at the 133.75 level. That's this right here. That is if I just hit the move in thing. You see this July low, July 2013 low. This is a big, huge swing low, and then the market started to trend to the upside from there. If you take a Fibonacci retracement of that move to the upside, the 133.75 level is where that 50% retracement level comes in. And people know me, I like the 50% retracement level. It's kind of the apex of the seesaw, and right now the market's sitting right on that apex of that seesaw, that midpoint, where we're neither going higher or lower. That's off the daily chart at least. And in fact, 8 of the last 9 trading days, the market's traded above and below that 133.75 level. But we haven't been able to get too far above, haven't been able to get too far below. And so we have something that looks like this on the hourly chart. And on the hourly chart, we did try to move above the top side here, ironically, right at the headline time of the Ukraine thing that happened today. For whatever reason, the market moved above that trend line, so it probably stops being triggered, the market moving higher. And then they're like, wait a minute, the euro should go lower. Why? Because it's more bad news for the European economy. They're closer to the Ukraine, closer to Russia, they're bigger trading partners with Russia. So that is going to have a bigger impact on their economy, and so we're seeing the rotation to the downside. But really, from a technical perspective, forget about the fundamentals, folks. Let's just look at the technicals. Any sort of move above here or below here is going to dictate what the bias is going to be in next week's trading. So what is this level? This level is a 200-hour moving average. This is a 100-hour moving average. Get below that, and that's going to be more bearish. Now, we were below it earlier today. We fell below it in yesterday's trading, and then we moved above it, and then we had this, I don't know what happened here, but we need to get and stay below this level. Needless to say, we need to break below this trend line down on the downside. On the top side, if for whatever reason, and it's not really a fundamental reason, but from a technical perspective, if we move above this level right here, it's more bullish. And then we get above here, and we get above here, and we start to look toward higher levels here, including the top side trend line and other retracement levels that we haven't really typed in. But this is going to be the key level for obviously reasons, and then we're going to look at that high, and we're going to look at that high right there. So that's the euro versus US dollar. Now let's take a look at the sterling versus US dollar. In this week's trading, we saw a big move to the downside on the inflation report that came out on Wednesday. Initially, that inflation report did this little fake move to the upside, almost like the Ukraine thing, and then said, wait a minute, it's going lower. They're more dovish, and so we saw a sterling move down. But we found support against the 200-day moving average over the last 3 trading days. The market hasn't been able to. Actually, it got a little bit. It got 2 pips below the 200-day moving average in yesterday's trade. Maybe it didn't. Maybe it came right down to that 200-day moving average. But for whatever the case, whether it's 2 pips or no pips below the level, the market did find support and has been finding support against the 200-day moving average. And we haven't been below the 200-day moving average since these days right here, going back to August, end of August of 2013. That's nearly a year ago. So needless to say, key level next week, the 200-day moving average currently coming in at the 166.61 level. Off the hourly chart, not much ever since we went down and tested that 200-day moving average yesterday. We've been going sideways, neither higher nor lower the B, but it has allowed the 100-hour moving average to start to move down toward the broken trend line area right here, the underside of the broken trend line. And the 100-hour moving average probably going to converge sometime on Monday or Sunday night, or somewhere around the 167.21 level. And any sort of move above that level will open up the door for the test of the 200-hour moving average, which we have been below for a long time here as well. A number of days here. Each of these lines represents a new trading day. We did move above it here again right before or right after the inflation report headlines on Wednesday came out, but then the market said no. Go lower, and then that's when it started to trend lower. So sterling versus US dollar, we're watching here, and we're watching down here against the 200-day moving average. All right, let's take a look at the dollar versus yen and talk about a currency pair that doesn't know which way it wants to go. This is probably the most not knowing which way it wants to go currency pair on the face of the major currency pairs, at least. This is the year. This is a high for the year. This is a low for the year. And so from really February on, the price has, we had one peak here, and then we start to narrow it up, and really from this part on, with everything has been even more narrow here. The spring is getting tighter and tighter and tighter, and I know I've been talking about this for a while, but it is. And the trend lines are coming closer together. The moving averages are converged. They converged to here. They're getting very close here. Market went a little bit below it. We have this trend line here where we found support end of last week, and we can't get above it. So right in between here is 100 and 200-day moving average, and without getting into anything more detailed than that, and you really don't have to. All you have to do is try to keep things simple, folks. This is the big, huge line in the sand in between the 102.30 level and the 102.06.8 level. And as long as the price stays above, it's bullish. If it moves below, it's bearish. So, whatever the market decides, it decides. And the next level to get above is this level, and then we need to get above that level, and then it opens up the door to this level. That's on the upside. On the downside, if we go lower, we need to get below this trend line right here. So you can have a bias one way or the other for the dollar versus yen, but understand where your risk is, and the risk is defined by the 100 and 200-day moving average, so pay attention to that. All right? So that's that. Dollar versus Swiss. Saw a flight into the relative safety of the Swiss franc here today. It's kind of safe to do that because we're off the lows here. The dollars versus Swiss have been moving a little bit more higher over the last, since the low in April here. We had the double bottom right here, been moving higher. not racing away. We're below the 38.2 of the last move down from the 2013 high price right here all the way to the downside. So it's not necessarily racing, but today we made a new low, fell below the 38.2% retracement of this move to the upside from the July 14th low up to the high. This is where the consolidated, and we started this trend move back to the upside. So we fell a little bit below that floor area right here, and that's going to be a key level in trading next week. This 90.31 level, stay below it, and it's more bearish. Look for further selling. Move above it, and where do we go? Let's probably look toward the 5 minute. Let's go to the 5 minute chart here. Oops, I'm on the wrong currency pair. I don't have the 5 minute chart. Anyway, we probably look toward moving back above these lows right here, and if we do that, that would be more bullish. What I like about this chart in the last few days is the inability to get above the 100-hour moving average. So it really was set up here. Traders who sold against this level are definitely in control. They may be taking profit down here because they won here today and they're going into the weekend, and perhaps it's influenced by these geopolitical things. But that's what it's all about. Is defining risk and limiting risk against certain levels like this level right here and having the market do what you think it should do, and indeed it did. Speaking of trading between support and resistance, if I were to take out this line right here, this is a nice, well-defined trend line right here. Well, it's just defined by 2 points, but if you put a parallel trend line against these lows right here, that's where the market found support today in the dollar versus Canada, and we came down off of what was fundamental data. The employment report came in much stronger than expected. This is a redo of last week's report. I won't go into that, but then we came up and the shorts started to get squeezed, and the market moved right up to the 100-hour moving average. So we're in between this support level and this resistance level on the hourly chart. We also have key support from the 100 and 200-day moving average. This is the blue line, the green line in the chart, and that's where the market came down and bottomed against in trading here today. We actually moved a few pips below that level, maybe 3 pips below the lowest moving average, and then the market rebounded back to the upside. So needless to say, this area is key. 108.63 is where that level comes in. As long as the price remains above that level, that's more bullish, but by the same token, if it moves below, it's more bearish, and by the same token, we have resistance up here against the 100-hour and the 200-hour. So this is 200-day, this is 100-day, this is 100-hour, this is 200, and that's where the market's ping-ponging in between for the dollar versus Canada. So that next week we're going to be watching those areas, and quite frankly, the fundamentals are a little bit bullish, a little bit bearish. And so it can go either way. So might as well play the range or lean against the levels and see what happens. Speaking of leaning against levels, the 100-day moving average in the Aussie versus US dollar comes in at the 93.38 level, and the market high today came in at 98.33. As long as the price remains below that level, it's more bearish. If it moves above it next week, that's more bullish for the Aussie versus US dollar. On the downside, we have the 100 and 200-hour moving average, very similar to what we saw in the Canada, where the 100-day moving average and the same type of thing. 100 and 200-hour moving average comes at the 92 level, and as long as the price remains above that, it's bullish. So here's bearish up here against the 100-hour moving average. Here's bullish down here against the 100. Or this is a 100-day moving average. This is 100 and 200-hour moving average, and that's what you need to lean against. Finally, I'll take a look at the New Zealand versus US dollar. And in trading last week, the market came down to the low price from the month of June. Found support. That was this week. The market came down to that level on Tuesday, found support, and then we started this rebound to the upside. Yesterday, we moved above the 200-hour moving average, 200-day moving average, I should say. That's a green line in the chart. We also moved above the 200-hour moving average, and in trading here today, what did we do? We found support against the 200-hour moving average. And that is controlling the bias now for the New Zealand dollar. Above the 200-day moving average, above the 200-hour moving average, the bulls remain in control. The fact that both those moving averages, the 200-hour, 200-day, 100-hour, 200-day, all at the same level or near the same level, that provides our line in the sand, folks, for next week's trading. As long as the price remains above this area, it's bullish. If it goes below, it's more bearish. It doesn't have to get any more complicated than that. If we stay above this level, then and you're bullish on this currency pair, look for the 33 level, 85.33, and then look for the 85.70 level to be the next targets on the top side for this pair. So that about does it. I want to wish everybody a great weekend. Also, a happy and peace-filled weekend for you and your families. The world is full of anti-peace at the moment, and peace starts from within, from individuals, and it spreads. So keep that thought in mind. Have peace in your family, have peace in your life, and the world's going to be a better place. My name is Greg Michalowski. Talk to you next week.